Ladies and gentlemen, good day and welcome to Music Broadcast Q1 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashit Kokian, CEO, Music Broadcast Limited. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining the Q1 FY23 earnings call for Music Broadcast Limited. Joining me on the call is Mr. Rajiv Shah from our IR team and our investor relations partner, Strategic Growth Advisors. It gives me great pleasure to talk to you again in times where the country has been fully opened up and the pandemic seems to have trailed off. To substantiate my point, as per industry research reports, advertising volumes recorded a 5.7 times growth in May 2022 year-on-year. The tally of categories has increased by 51%, while the count of advertisers and brands has increased 3x. This brings back the much-needed optimism that many industries, including ours, has been wishing for the past few quarters. Where digitalization, as I explained over the last 2 quarters, is driving the next lever of growth with radio at its core. Using the fundamental resources at hand and combining it with the advantages, reach, and customization of digital to reach a far greater audience provides better and targeted content, and in some cases even opening up markets which previously didn't exist. By enabling RJs to produce text, audio and video material, RJs with a strong social media presence also engage with their audience more effectively. Additionally, RJs have grown to be powerful influencers which aids broadcasters in generating revenue. The volume rebound serves as more evidence of this. Talking about client counts and market share, Radio City has continued to maintain a lion's share of 38% of the total clients. From an industry perspective, 2.24 thousand clients are new in Q1 FY23 out of the total 4.05 clients who advertise on the radio platform. With the festive period coming and pandemic cooling off across the globe, leading to free mobility and the resumption of outdoor events. The upcoming quarters look promising and will boost our recovery as guided earlier. Our market share has stood strong over the time, and we exited the previous year with a 21% market share. This, at the end of Q1, stands at 18% owing to refusal of certain low ER clients, which is in alignment with what we have always maintained, that we aren't playing the volume game. And while this results in a dip this quarter as far as volume is concerned, but we believe that this will help us having a greater value share owing to the higher pricing. Coming to the sectoral ad spend, we observed a phenomenal growth in major sectors which albeit on a lower base signals strong recoveries and great prospects moving ahead. Real estate, which contributes 17% to the industry, grew by 389% year-on-year, while pharma, which contributes 11%, grew by 139% year-on-year basis. A staggering growth was observed in the electrical, auto, food and soft drink segments as well, with these core category sectors growing by 319, 115 and 30% respectively, and contributing 7, 6 and 6% of volume respectively to the industry. Over the past few quarters, the negative trend observed in the government sector was overturned with this sector growing 47% and contributing 6% to the industry. Approximately 14.75 crores of the top line, or 34% of it, came from new revenue opportunities. Our internal forecasts predict that these revenues will continue to increase as well. A few lasting cost reductions have been achieved by deliberately optimizing efforts, yield significant benefits that are expected to continue for the foreseeable future. On the collections front, the company has managed to collect rupees 51.73 crores during the quarter, of which the collection from government stands at rupees 4.89 crores. These efforts on the recovery of revenues have led to the NOD further reducing from 164 days to 135 days. Coming to the financial performance of the quarter gone by, we registered a growth of 116% year-on-year, increasing our top line from rupees 20.5 crores to rupees 44.1 crores. Our EBITDA has turned a leaf from being a negative rupees 9.3 crores in Q1 of FY22 to turning to a positive 8.8 crores in the Q1 of FY23. This translates to healthy EBITDA margins as well of 19.8% in the current quarter as against a negative 45.5% in the same quarter last year and 13.3% in the Q4 of FY22. This turnaround is a result of a combination of factors including realized operating leverage advantages, internal cost efficiencies initiatives and returned advertising expenditures. We have always placed high emphasis on maintaining a healthy balance sheet as seen by the sizable reserves we have available. As of 30th June 2022, our cash reserves were rupees 273 crores, up from rupees 264 crores on the 31st of March 2022, demonstrating our good liquidity position. These sources offer the tools needed to take advantage of current and potential future possibilities. Building on several projects from the previous few quarters, digital integrations have evolved into our core pillars. Our social media presence is significant. Across all platforms, we reach about 245 million people. We provide a wide range of digital solutions that give our clients omni-channel, end-to-end solutions for their products and services. The sum of all of these factors increased our digital revenue for the quarter by 169%. Lastly, with regards to the bonus issue of the non-convertible, non-cumulative redeemable preference shares, the meeting of the equity shareholders and unsecured creditors of the company was held on Thursday, June 23rd, 2022, wherein the shareholders and the unsecured creditors have approved the scheme and thereafter the company has filed the petition with the NCLT for further course of action. We will keep you posted on the developments as they unfold. With this, I would request the moderator to open up the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nisha Desai from NM Securities. Please go ahead.
Thank you for the opportunity and congratulations on your numbers. I have a couple of questions. First question is, we have been seeing record attrition levels in the other industries over the past year and the major wage escalation to retain the talent. So we have observed that the Radio City does a great job at retaining its talent. Are you seeing any shift in that trend or any churn in the talent pool?
See, as far as any competitive business, the risk of good people leaving will always be there. But I think the way we have worked at Radio City is
Okay. And that's again quite helpful. My other question was that on the non-radio business, so it is becoming now a increasingly bigger size of the revenue pie. What is the EBITDA margin on that business vis-a-vis the radio business?
See, all for us as a thumb rule, any business which is non-radio, our understanding is very clear that it should be a greater delta booster, whether it is EBITDA or PAT as far as the business is concerned. And hence, I can proudly say that it is a much better margin than the core radio business that we talk about.
I see. And then just last question, since the Q1 of last year was obviously COVID impacted, so if I look at your following 3 quarters EBITDA margin, it was around 25%, versus we have done around 20% this quarter. So if that is because of seasonality or you had higher cost, if you could just...
So it's a seasonality because even in the last investor call meeting I had said, typically there is a 15% drop that happens from the Q4 to Q1, and then you have a marginal drop in Q2, and then it picks up in Q3 and Q4. So historically Q3 is the highest quarter, followed by Q4, then Q2, and then Q1. So that's the way it follows. And I think that is the pattern that we are also seeing right now. So there is not any great cost. The only marginal incremental cost you will see is the digital part of the cost in keeping in line of the future requirements of this organization. Having said that, even with that increased cost of digital, the margins in that part of the business is more than the regular business that we can talk about.
Okay. And then just lastly, on the government side, if you have any comments on that verticals, because your competitor was saying that the government business is still weak. So I was just wondering, what are you guys seeing in that vertical?
The government business is slightly picking up because now with the state governments, whenever there is a state government, the state government will start advertising. As we come closer to the 2024, so the last quarter, you may find the government now taking a posture of advertising to create, the good effect of whatever they have done in the past 3.5-4 years. So that is what will happen at the second end from the central government is concerned. State government is advertising, and state government will go higher in the markets where there is elections happening, and also the tourism with this pandemic and all opening up, you will see a lot of India local tourism ads coming from the government. So that is something which we are looking forward to.
Great, thank you. That's all I had. Appreciate it.
Thanks, Rajesh.
Thank you. The next question is from the line of Virat Shah from Shah Investments. Please go ahead.
Hi, sir. I have a couple of questions.
Yes, Virat.
First question is, can you help me with the capacity utilization figures of legacy batch 1 and batch 2 stations for FY22?
Sorry, come again.
Can you help me with capacity utilization figures of legacy batch 1 and batch 2 stations for FY22?
Yeah. So, can you be a little louder, please? You're cracking.
Hello, am I audible?
Yeah, yes.
Sir, can you help me with the capacity utilization figures of legacy batch 1 and legacy batch 2 stations for FY22?
See, the legacy batch 1s are all at about 65% utilization level, and the legacy 2 is also approximately at about 60% utilization level. The batch 3 is about a 45% utilization level as of now.
Okay. And sir, concerning about the cash and cash equivalents on our books, we have been observing the growth in every quarter. Have we aimed to deploy the cash, whether in inorganic acquisitions or expansion in number of radio stations or any other initiatives?
See, like any expansion of currently, like we said, every opportunity is weighed at the time when we feel that there is an opportunity that we need to invest on. Currently, as we speak, there is nothing that I can foresee immediately. However, having said that, as our whole digital ploy gets increased and our whole play gets increased, wherever there is an opportunity, we will deploy that, keeping the larger interest of the organization and the shareholders to ensure that there is a great profitability for the existence of brand Radio City as we go forward.
Okay. And what are the current initiatives that are giving us a good ROI? If you could provide an update on that.
Yeah. So, for us, apart from the fact that there is a plain vanilla advertising that the medium always gets, what we as Radio City have always tried on is this whole creative business, as we call, or solutions that we provide to advertisers, which is, straddling multiple mediums. So today a lot of our success is coming with the integrated solutions that we give to clients, while, it's a much cliche term which I keep saying that the consumer is no more linear, and I keep telling this in every investor call, is that as the consumer is becoming hybrid, we are very clear that we will want to reach out to our brand's consumers in whichever platform the brand consumer is consuming content, whether it is social media platforms or streaming platforms or on ground or radio. So our solutions are all multiple platform-led solution, and that is giving us huge results, because that's how our integrated solutions happen. I've always told that Radio City has always had this faith in itself, saying that we are great storytellers and our creative content selling is amongst the best in the business, and that's why our creative team Audacity is known as the best creative hot shop as far as radio advertising is concerned, and now beyond radio into even digital advertising. So that's the way we look at it. So for that combination of knowing the pulse of what consumers want from a content perspective is what we believe we do best. That's the first part. The second part is where very clearly, as the world moves itself towards social media influencers, we have a depository of large influencers in the form of our RJs, which we are effectively using for brands to make those communications with their set of audiences. So it's a combination of all this. And lastly, like I said, this whole need to have experiential feels for brands when you go on ground. We believe, the kind of following our RJs have, we've been able to engage with consumers on ground with specific events, which is one more opportunity that brands see to associate with us, and all this in combination is where the results are coming from.
Yes, it was helpful. And sir, as festive season is coming up, have we planned any initiatives which are yet to launch?
There is a lot of things. Keeping in mind the seasonality, we do a lot of events like, during Ganesh Chaturthi, we have customized Ganesha events specific to specific regions. In Bombay, we have something in Ganesha. Down south, we have something in Ganesha. With Navratri coming in, we have the Garba Premier League that we do. So there's a whole lot of festive-led, on-ground-led, on-air-led initiatives that we do year on year. And we also do a lot of localized events which allows brands to kind of interface with their consumers. So that's something which is, and we follow a set calendar for ourselves, so that we don't struggle at the last moment to try and put things in place. So right in the beginning of the year, we know what are the major festivals coming, because in India they say that when the mood is celebratory, the consumption increases. That's the typical mindset, and we try to ride on those celebratory moments of the consumers. is at 44 crores right now, very clearly because of I'm still operating at the 70% yield of my pre-COVID numbers. And that is why I personally believe that any change to get closer to your pre-COVID numbers will be largely driven by a revenue strategy through your pricing rather than a volume strategy, because at some point the volume will get stagnated.
Okay. So this is what I'm trying to understand, that Q3 we seem to be getting a much back to normal Q3 last year, but again now we are seeing 45 crore average run rate, which is way lower, at least a good 40% or lower than the previous few pre-COVID revenues earlier. So are we going to attain that run rate anytime in the next couple of years, or that's still a long way?
So that is a very difficult issue. Now I will need to have a future understanding beyond which at this point in time is very difficult to predict. Having said that, I'm very clear that there are 2 points I will make in this communication of yours, which is one is how close are you going to get to the top line numbers of pre-COVID? Your company has always been chasing the bottom line, and you always know that we have never been a top line driven company, we've always been a bottom line driven company. If you ask me a question, I'm more comfortable to say that you will see the bottom line or the PBT numbers that we saw pre-COVID in the next 4 to 5 quarters rather than the top line numbers, because top line numbers is today a little colored because of the discounting offers that is happening in the market from a volume perspective. And I've given you a couple of examples of that. So I would look at, reaching out to my pre-COVID numbers PBT much earlier than reaching the top line numbers, because like over a period of time we have gotten cost measures which is working well for us, and the business which we are banking, which is beyond radio, like I told you, are better EBITDA boosters or bottom line boosters than the traditional business of radio. So my strategy is very clear: do my best as far as radio is concerned and get to the maximum that I can do through a pricing and volume strategy. The new businesses or opportunities that we create through on-ground, through social media, through digital, which is a larger delta booster as far as my bottom line is concerned, and get far closer to the pre-COVID numbers, and beyond the point not really be too carried away with the top line numbers, because that can at times be misleading. That's my strategy, and I think in a way we are closely in line with what that strategy is.
Okay, that's very helpful. Thanks for that guidance. This second question is overall on the radio industry growth rate. I don't see any slides that you share around this. So if you can sort of share the overall market size and how fast or slow the industry is growing. I want to understand if there is any natural growth in this industry, or is it just a fight for market share right now? So if you could also create some slides in the presentation, that would be helpful, and if you can share some color on the industry growth rate.
Okay. So I'll talk of the pure radio growth. I mean, when I'm saying pure radio growth, I'm not talking about the initiatives that we do beyond conventional FCT advertising, which is your integrated solution and advertising funded programming, the on-ground led avenues, and the digital as separate. I still believe that the core radio in isolation will still grow by about 12 to 14%. However, most radio players are today looking at themselves as not just radio. We are radio, we are on-ground solution providers, we are on digital solution providers, and we are also providers of syndicated content. Now that part of the business, I mean, I can proudly say that you will see at least 25 to 30% on an average CAGR growth for the next 4 to 5 years. That's the first part. On what basis I'm saying that? Because when we are talking about this whole integrated solution, which has a lot of influencer-led, marketing-led brand communication that is happening, that space already is more than what the radio space is. The radio space is about 2,000 plus odd crores. That space of only influencer-led marketing is about 4,500 crores. So the opportunity is double of what radio is. And we should look at our opportunity as not just the 2,000 crores of radio. It is actually 6,500 crores of radio plus digital. And if I have to throw in the events part of the business in which we operate as an industry, I think we are already chasing 8,500, 9,000 crores of business. So it is no more a share of what 7-8 years back of radio being just a share of the radio business. I think all radio players are looking at the share of the multiplicity of these opportunities, which is in its own 4 times more than what the radio opportunity is.
Okay. So the core radio market in itself is around 2,000 crores, and you believe that also is growing 12% plus?
Yes, yes.
Okay, great. So yeah, if there is some material that can be created for investor presentations, that would really help build the confidence.
We'll figure it out.
And just one last point on the NCRPS. What are the next steps and tentative timeline, since you know, right, it's almost 2 years since you announced this, and something shareholders are looking forward to?
I think the major part of the hurdle is it's over with all being accepted. The shareholders accepted. Now it is as long the procedure takes place, because from our perspective there's no hurdles at this point in time, because all that needed to be cleared from our side and from the shareholder perspective, everything has been done. Now it's just a matter of time as far as the procedural time that takes, and that unfortunately I can't give you any indication of when it will happen, but we believe the current set of people are from the government perspective or people who are involved in this are fairly efficient, and we should see soon something coming out of this.
Okay. Any tentative timeline? 3 months, 6 months, 12 months?
Honestly speaking, I would love to say it is 6 months, but it's dependable of as and when it happens. We have a strong feeling it will be earlier, but like I said, it's just a speculation from our side.
Okay. Thank you very much, and all the best.
Yeah.
Thank you. The next question is from the line of Mohit Khanna from Banyan Capital Advisors. Please go ahead.
Hello, sir. I just wanted to know if I have missed this before. What are the debt levels for you in this quarter end?
Zero debt. We are a debt-free company.
But I can see some sort of a finance cost on the P&L. So what exactly is that then that you might be incurring?
This is the finance cost relating to the leases we take out for our stations.
Okay, that basically primarily the lease expenses.
Yes, it's finance lease.
No, understood, sir. So, another question was regarding the yields. You just said in one of the answers that we are still operating at 70% yield versus pre-COVID, and that is one of the reasons, your revenue is down compared to pre-COVID. However, you would see the profitability coming back at the PBT levels, which is compared to the pre-COVID. So, what exactly would be the drivers, according to you, when you say that yields might be lower than pre-COVID, but we would be on the PBT level touching pre-COVID levels?
2-3 reasons. One reason is, like we said, we have done a lot of cost measures, which obviously will reflect in the bottom line, number one. Number two, like I said, as far as our pricing strategy is concerned, we are looking at marginal movements from variant is also had affected because it's a mix of local plus corporate advertisers that we have as a mixture, right? So that was the reason why we believe that challenge is still existing. But now that in the last 1.5 months, I think slowly that is beyond us because life has come back to normal. So yes, the metro market, especially Bombay, Delhi and Bangalore, unfortunately had this whole little, bias towards the COVID being affected because of whatever those numbers were reflecting in our overall scheme of things for the industry and not just the thing, and that is reflected in the overall radio volumes. My next question, the next answer to this thing is, I think already we are seeing signs of improvement happening because life is coming back to normal and now the festive kicking in. We believe it should get back to at least, if I have to take a risk of putting up the number, anywhere between a 75 to 80% bare minimum utilization level. Yeah, and from there on, at the peak we touch 95%.
Fair enough, sir. So
like I said, the ERs is any which is going to be simultaneously being pushed up, so that there will be a combination of the increased volume through this extra utilization of inventory, and that marginal push that we are getting through the ER will be the net gain that you see quarter on quarter.
Right. So in that scenario, see, in the fourth quarter we did around 4% operating EBITDA margins, and right now we are at 9.5%. So will it be a fair assumption on the analyst community side and the investor side to assume around 15% of EBITDA margins in the second half of this year?
I wish I could give you an answer to this, but yeah, I mean, our attempt is to do what we are, showing as a efficient matter from our side. But I think I would rather want to take you all to kind of look at it from a perspective of that so far things are played as per the kind of strategic direction we are taking, and should possibly believe that we should be able to deliver what we are talking about in terms of the overall margins.
So I mean, I understand you don't give guidance. So does it? I mean, I'm only asking if the number looks reasonable to you or not. That's it.
See, let me answer this question a little differently without really committing myself to something, because it will be just one statement from my side. I see an upside of my volumes, revenues going quarter on quarter from now on, and I have already made my statement saying that once the critical costs are taken care of, any incremental revenue will straight away go down. I mean, that's the thumb for us, and we believe at this quarter's level of revenues, we are a break-even. Any increase that you will see, to whatever extent, 6, 7, 5, everything quarter on quarter will go down, and that will improve our margin in any case, So that's the way you would want to look at it.
Fair enough. That was very helpful, sir. Thank you so much.
Thank you. The next question is from the line of Dipti Kothari from Kothari Securities. Please go ahead.
Good afternoon, sir. Thank you for the opportunity. So my first question was that we entered the previous financial year at a strong market share of 21%. However, that has fallen to 18% in the current quarter. So just wanted to understand the reason for this fall, and if there are any changes in strategies to recover the lost ground.
No, there is no lost ground. In fact, in the earlier question also I mentioned that we believe that, for any business where you have a limited utilization, a limited inventory and a long-term plan, you need to look at it from a perspective of what is the kind of revenues you will look at. So I'll just give you a back of the envelope calculation, which we have those recorded volumes happening. Imagine I wouldn't have taken any rate hike for the quarter one of this year, and I would have gone with the same share of 21% that I had. I would have still done 2.5 crores lesser than what I have done. So for us, the strategy is very clear. It's pricing driven, and it's a strategic call that we have taken to ensure that we believe in the long run, we should have a higher revenue share rather than having a higher volume share. I already gave you examples of one of my competitors, and I can give you 2 examples of a volume share increasing by 2%, but revenue growth half of what I have shown when I have not actually increased the volume share. When I was at a 21% exit, I was 21% last year, but I showed a double the growth of somebody who added 2% starting from the beginning of the year to the end of the year. So that, to my mind, is where the strategy gap is. We believe that because of the kind of stations that we have, and maybe that is because we have a larger share of fairly more advertising attractive markets vis-a-vis any of the others, because if you see our mix of revenues coming from the advertising attractive markets, as we call, where advertisers believe that they have to be present in a large scale, vis-a-vis the tail end of volumes and markets that we are able to justify that far more, and it is showing in our results, not just in one quarter, but in the annual growth that we talk about also. And as you all know, we don't have a long tail.
Yes. Okay. And sir, the EBITDA margins have improved from 13% to almost 20% in this quarter. So will these margins be improved even further going ahead, or do we see some headwinds in the near to midterm denting the margins?
See, we would want to do the best as far as margins are concerned. But as I said, in our exploratory part of the business where we are looking at a lot of digital future for the company, there could be times where we would possibly want to invest more in the short term and get far more in the long term. Those are the days or times where you may not see that matching, but that is as and when, like I said, it will follow the priorities of the organization as far as the business is concerned.
Okay.
And it's a conscious call. It will be by design and not by default.
Okay. And sir, while looking through your presentation, it was heartening to see the return of ad spends and all the major sectors growing significantly in volume. So which sectors, in your opinion, are expected to sustain this growth in the upcoming quarters?
I think all the most major sectors that you have seen, whether it is real estate, whether it is pharma, food and soft drinks, all those sectors will be sustaining, because those are the sectors where any which is not just in our medium but also in other mediums advertising. So I don't see any sector falling out. In fact, starting the end of second quarter, I also see finance, which is currently missing, will be back in the foray, which will also add on to the overall volumes.
Okay. Thank you, sir. That answers my question.
Thank you.
Thank you. The next question is from the line of Apurva Mehta from AM Investments. Please go ahead.
Hi, sir. Just wanted to know this, created businesses which we are reporting of 14.8 crores, and roughly that is around 34% of our revenue. So, going forward, what can this created business, grow, and how can we grow this business, and what is your assessment that can this become a 50% kind of business of your total revenue?
See, we in our overall strategy, we are chasing a 50-60% growth on the creative business, because that is the opportunity that we create through pure creative solutions that you give, and that includes digital solutions that we are talking about. So if you see our presentation, we have grown by about almost close to 170% on our digital part of the business, which is again a creative solution, because it is an idea-led created opportunity that we give in the platforms of the choice, which is the digital platform of the consumers. So we are chasing every city business is concerned, or the plain vanilla business, which is, as we said, which is at a 65% utilization level in Bombay, Delhi and Bangalore, and overall utilization level at 55-60%. When that increases, basis the base, you will see what the contribution is. But so I can't really tell you whether it's going to be 50% of what you are. From a size, from an absolute number, it will be growing quarter on quarter is what we believe.
Because last 3 quarters we were like flattish of 14.5, 15 crores, 14.5, 15. Only Q3 we had a little better quarter where we had clocked 22 crores. So, I thought this pie would be, ballooning over the quarter on quarter every year. But
because in Q3 and post Q3, the little part of on-ground solutions that started kicking in, and our digital payout started going and giving more, because when the beginning of last year when we started out, we created certain opportunities and we kind of built ourselves in the ecosystem also to create those great video content and so on and so forth. Now as that gets built up, and that, as you know, for us it is a large opportunity for us, and that is really working for us, and then that is where we believe that this will increase for sure. What percentages I can't guarantee, because I also am seeing the core of radio also simultaneously increasing. So that is where the only catch for me not to able to kind of give you the percentage per se.
On the yield front, on the exit quarter of Q4, we should see this yield coming to 90% pre-COVID levels, roughly?
No, like I told you, it's pre-COVID level 70%.
Yeah, but in the exit Q4, we will be increasing the ad rates definitely, and what you are guiding.
We have increased by about 14% from last Q4 to now. So As we go forward, the 90%, see, this whole rate game is not just a one player game. I am sure you'll understand that.
Yeah. I agree.
Is that, for some strange reason, someone who we always believed was as much premium as we were in the marketplace has suddenly shown a different strategy, and that is not really helping the industry per se. So having said that, like I said, to each his own strategy, we will be gradually moving ourselves to a fairly better price place player, which we always were, and ensure that our margins through that strategy will be more than what we would conventionally do by just garnering up volumes in the market.
Sir, your guidance of 40% kind of growth which was there, against last year, roughly 35-40%. Do you stick to it, or it will be now because Q1 is softer, so it will be difficult to reach to that kind of thing?
See, for us, like I said, our play in the newer forms of business is where we are taking the larger growth. 30-35% growth is what one should, conventionally chase, to be having a sizable share of the business that we are. And given the base of what last year it is. So we are chasing aggressively the business in that format.
Okay. Thanks a lot, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Omkar Harkar from Mirabilis Investment Trust. Please go ahead.
Hi Ashit, this is Srinivas here from Mirabilis.
Hi Srinivas.
Hi. Ashit, just wanted to get more color on the utilization of the fairly solid cash reserve that we have. We have been collecting more than we earn. So broadly at 270 crore kind of a balance sheet size, what are the optionalities that are there? Because last year the company was not able to declare dividend, I suppose, because of loss. But broadly, and I understand the NCRPS will in some way result in some cash being kind of set aside for that. But broadly, as a management and board level, what are you looking at in terms of options for utilizing on the cash, either in terms of, say, business acquisition or, say, some kind of a further return of cash to the shareholders?
See, like I told you, a large part of our strategy is futuristic in terms of our deployment of a digital strategy that we have, which is, playing a larger role in this whole influencer marketing space and the money and the opportunities lying out there. As we go forward quarter on quarter, and as we build our resources in that part of the business, we will, keep a close eye of opportunities which will help us scale that part of the business apart from the normal growth that we are looking at, and that is one area we would be actively looking to kind of see if there is any investments required. As far as the radio business is concerned, I think we are already existing in the core advertising attractive market, and because the digital part of the business is giving me a greater bottom line, I would rather chase that part of the business more than the core radio, which I think we have got a substantial presence, and that is the way it is. Unless there is an opportunity which which tells us that even that play is available and we will play. So like I said, it's a decision that will come over a period of time as we progress ourselves and as we see the position improving from our overall scheme of things. And hence, I think the best way to look at it is little off the cuff. I told you one of the biggest companies in India was looking at opportunities of investing outside the country in the business that they wanted to, but was advised to keep the money to save off internal competition. And I know you know who I'm talking about. So if they can think about keeping the money for themselves for a better time, with the kind of cash reserves, I think I should be allowed that prudency to keep that cash for better time and invest it intelligently.
Okay. And any feedback at a board level on how to look at the cash distribution to the shareholders? Because I understand that at a PBT level we don't make much, but at least on a cash level we are generating.
I can only tell you one thing. Your company has always been looking at the interest of the investors always. So, and whenever there is an opportunity, that in whatever little opportunities were there, we are always more than happy to do that. I would only urge you to have faith that let things play out the way it is in a much better fashion that it is, and the board is mindful of this need that arises from the kind of investments that you do and the faith that you show on us. And we would not want to let you down, but like I said, it will only come over a period of time for us to even give you any kind of an indication.
Right. The second question is on the other expenses. Like this quarter, we have 22 crores versus say 24 to 25 crores in the last year. So, is there any cost rationalization, or are there more seasonal items which came in the second half of last year because of which it has dropped?
So last year, what we did is, this question I had answered last time also. We've been kind of, very clearly looking at our debtors and to ensure that there is, we don't veer away from the fact that is the potential loss of revenues not coming in because for whatever financial ability as some part of your debtors would be. We have increased in the last half of last year a provision for doubtful debt, and that possibly is reflecting in our P&L.
Okay. And just to kind of close the loop on that, what are our old debtors, especially I think government accounts had a lot of pending dues. Broadly, how has that old bucket trended for you in the
The government has been a little slow, but our commercial accounts are really well in control. So we see no reasons from a commercial perspective of having any challenges. However, the government is a little slow, but traditionally and historically, government, even if it is over a period of time, has never been bad, debts for us, and we believe that is the way it's going to be for us.
At this point of time of the kind of pending debtors, I think the last number we have is for the last quarter, that's 76 crores. That would have come down, I suppose. So broadly of the current outstanding debtors, which could be the slow-moving type of thing?
Now, yeah.
70, okay. And within that, any major slow-moving debtors which are yet to be provided for?
No. If you see, even in this quarter we have provided, but as we go forward, we have a process in which we see if there is a provision needed, irrespective of the P&L, we do provide that. And hence, if you see last year in the second half, we provided more when we did this whole analysis. So that is an exercise we do continuously, and we can assure you that if there is a need, it will be provided for.
Okay. Great. Thanks, Ashit. We wish you all the best.
Thanks so much. Yeah.
Thank you. The next question is from the line of Mohit Khanna from Banyan Capital Advisors. Please go ahead.
Yes, sir. Just a follow-up on the category growth that you have in the presentation. So what are the other growth or the categories which haven't really grown as much and are sort of lagging, and what is your sense when they are going to, come back on the growth trajectory?
See, I personally believe, like I said, finance is a category which will come back in a big way in the subsequent quarters. I also believe e-commerce and OTT platforms will come up again and will be, advertising more. And that will come during the festive for sure reasons, obvious reasons. And, and the regular categories which is there is already growing, whether it is real estate, pharma. Finance, which is a high yielding category for us, typically grows largely in the second half of Q3, and Q4 is usually dominated by finance. So those are the categories which is absolutely near absence, I can say. There are, but they don't form in the top 10 at this point in time. So those are happiest times for them, because these are the categories which invariably year on year, whether there is recession, whether there is economic slowdown, have had the faith in the medium of radio and have been continuously advertising with the medium.
Right. And when we see real estate as a category, or pharma as a category that has posted very strong volume growth, are you also witnessing some sort of yield improvements in these categories?
Yeah, see, for us, real estate is a category which is largely volume driven. Having said that, there's a lot of corporates which has got into the real estate category, which values the brand and is willing to pay the premium. And, name all the top, whether it is Godrej, Mahindra, all big corporates are into real estate, and we are, and even the erstwhile big, and if I have to go local, someone like a Prestige in Bangalore or bigger, real estate agents in Delhi, we are very clear that we only pick up people who are premium from a property perspective and also from a pricing perspective, because like I said, that's the only reason why you will see that we are not blindly chasing volumes. We are very prudent about what volumes. So while the real estate industry will increase, our volumes will be depending on the kind of clients that we are chasing if they become active. And fortunately for us, most of them are active with projects across the country, whether it's Bombay, Delhi, Bangalore. And that's the happiest sign for us.
Fair enough. Thank you so much, sir.
Thank you. The next question is from the line of Apurva Mehta from AM Investments. Please go ahead.
Yes, sir. Just wanted to know: are we trying to make more digital content and gain market share? And is there any possibility to have more marketing people and gaining market share? Is it possible, because we have a lot of cash in books and we can use some of this cash to create more business, which is long-term beneficial to us? And now we with the normalization has returned, there is no COVID and anything, so the picture is more clear. So can we spend more and generate more business kind of thing?
See, I have answered this question in the past. The digital world of digital business is worth 36,000 odd crores. And even if I take, and I've repeated this in the past investors calls also, so 50% of that is your display, your classified display and search money. That leaves you with about 18,000 odd crores, which is structured between influencer marketing bit, which is both influencer marketing and advertising funded video along with that, and content creation along with that. If your answer is to that, should I increase my digital inventory through the resources that I've got and hence have a larger share of advertising? I don't see the business driven by volume rather than the idea-led solutions and impact that we create through the influencer marketing platform that we are talking about, or influencer marketing solutions that we are talking about. So at this point in time, we are not, and that's the reason why even when people ask me about pure radio, do you want to increase more opportunities in radio? Because unless and until I see there is great value coming from an overall scheme of things, I will not blindly go because there is an opportunity available. So to answer your question, the resources are there, yes. We are using it resourcefully as of now, but as we see the play increasing, you will see some logical investments happening which will give us 3x of what we are doing currently as far as that business is concerned. And purely when I'm saying that, it's the digital-led advertising business that we talk about.
Okay. So when you see opportunity coming in, you will spend more money, and that will generate more revenue. That's what.
Yes. It's all about short-term investments for long-term gains.
Okay. Thanks a lot. Yeah, wish you all the best. Yeah.
Thank you. Ladies and gentlemen, we will take the last question from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Yeah, hi. Thanks again. So going back to your comment about saying that you will be targeting your highest PBT in the next 4-5 quarters. So when I'm looking at your historical financials, March 19, you did PBT of 95.5 crores. So should we assume that, let's say, fiscal year 24, you could be at something similar level? Is that the right way to think about and interpret your comment?
I was talking about the 1920, which is a pre-COVID year for us, because if you go earlier, things were different. There was a different ecosystem and so on and so forth. Between then and now, there has been a sea change that has happened, whether it's in terms of available inventory, the overall scheme of things, the sentiment, the available opportunity from the world of advertising as far as consumer brands are concerned. So I think it is logical to look at where we were pre-COVID as the immediate pre-COVID. Now the answer to your question is that, do you want to see that kind of figures? Of course, over a period of time, you will see that figures, because that's what our overall game plan is. But I would rather hit the first figure, which is the pre-COVID 1920 figures, more than the earlier year, because it has many reasons why it was that, and that I think is now gone and over with, and I would want to possibly stitch the future with the aim that I should be as profitable I was in the year 18-19, and that's the whole game plan.
So 18, sorry, I'm confused. So March 20, you did about 29 crores of PBT.
Yeah.
And March 18, you did 75 crores. So you're saying your first target is to hit this 29-30 mark of year ended March 20.
That's our aspiration, and we would want to believe that the market will equally pan out, and we would want to have competing stations also be prudent in their incentivizing the market in terms of what rates to operate, because it's a competitive world. If you see competition going left, right, and center, discounting, you can't just stand there and say that I want to push this overall scheme of things in terms of the year. So that's the challenge. That is the only itch that is there in our scheme of things right now.
No, understood, and all the best. Thank you so much for your insightful comments throughout this call. Much appreciated.
Thank you so much.
Thank you. That was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining us in this earnings call. The organization will undoubtedly continue to expand on the advancements made in the previous year. The knowledge gained and the resilience built up to strengthen a dominant position in the market, further streamline operations, create higher quality content using our incredible talent pool, and utilize a wide network will help us achieve that. The presentation and results have already been posted to the company's website and stock exchanges. Please feel free to contact any of us or SGA if you have any more questions. Stay safe and take care. Goodbye.
Thank you. Ladies and gentlemen, on behalf of Music Broadcast, that concludes this conference call. Thank you for joining us, and you may now disconnect.